All right. Hi, we're AIO Financial. I'm Bill Holliday.
And I'm Alex Sanchez.
We are going to talk today about sustainable, responsible impact investing. And I think we discussed this in our podcast a month ago or so. And I think this time we want to tackle a little bit more about what are the limitations to it? What can it actually accomplish? Or is it a big greenwashing, not worth your effort?
And yeah, now that you actually say it, that there's been a lot of complaint lately for especially online. Whenever I start to research on good opportunities to actually make SRI investments, there's always people saying that, oh, this is just a greenwash, this is just losing your money, or it's not actually losing your money, but most of people think that it's not actually making a difference on whatever you want to do. You want your money to actually make an impact on society, on climate, or any sector that you want to invest yourself into. There are several, I don't know the exact amount, but there's definitely a huge amount of people that think that this is just a loss of time and effort.
Yeah, well, let's talk about that. I think when we look at people who are interested in making an impact with their investments or in investing in line with their values, I think there's two main things we see. One is some people want to use these environmental, social, governance criteria because they feel it'll help their performance in the long run. They just want to be out of fossil fuel industry because they think fossil fuel industry is not a good long-term industry, or they will want to be out of handguns or want to be out of alcohol or out of certain areas. One, because it's just they don't want to hold those things. And it could be for religious reasons. It could be for their personal values. It could be for the future of the planet, but they just don't want to invest in those holdings. And by not holding those, they're not making an impact. They're not changing the world. If you quietly sell your ExxonMobil shares on the secondary market, no one cares. If you loudly make a protest and it really affects the share price, all right, then you're making an impact. But if you're just avoiding certain industries, it makes sense. If I'm a nonprofit against drunk driving, my portfolio probably shouldn't have a lot of alcohol stock in it, just because it's, the values of my constituents. That's not something we want to hold. So I think that's one issue, just saying, hey, I want to avoid this. And I think investing in more responsible companies or sustainable companies that'll help performance in the long run. I think that's one argument, just saying, I want to pick certain companies because I think it'll do better in the long run. Okay. Number two would be you're trying to make an impact with your investments. And I think I could point to a couple of things. I don't know how slick I am at sharing this, but let me run to community investing. So one investment is through community investment notes. And there's a bunch of organizations that do this. These are the Calvert community investment notes. But you lend to them like a bond. You'd give $1,000 to this fund, and it's going to organizations that otherwise might not have access to capital at reasonable rates. And you lend it at the maturity time, you get your money back, and every 6 months you're getting an interest payment. So it works a lot like a CD. They're not FDIC insured, but they're going to help in these different areas. And these are some of the organizations that they're supporting, working on some different issues in the US and abroad. I think it would be hard to argue this doesn't make an impact. Maybe it's not for the risk. it might not be paying the best interest possible. But on the positive side, instead of just donating to an organization and you never see that money again, we have a lot of clients who are nervous about their future or want to have control of their assets. And so this is a way to support something positive, but you're going to get your money back at the end of a year or 2 years or 3 years, and you can reinvest it or not. I think another argument would be, or another area would be just using local credit unions versus using a multinational corporate bank. You know, you're keeping the money local, you're putting your savings account, your credit card to a local bank who's in turn lending to other people in the local community and not funding some multinational big project of, you know, some gas pipeline or something. They're funding local real estate or local projects. So, I mean, so that's another way you can participate with your money to make a positive impact. How big of an impact is that if I use a credit union versus using, you know, Wells Fargo? I mean, it's not changing the world overnight or anything, but I think it's a positive step. But it's not, you know, replacing government. I think so community investing is one facet. You are giving up return versus risk to lend your money to you know, to make an impact. I think the second piece we look at is, and I'll give a couple examples, but funds that are engaging to make an impact. And we can look at a few examples. And let me just run to, this is from engine number 1. And they have some examples of shareholder advocacy. So with Tyson, they worked on sustainable packaging. With Walgreens, they were looking at cost of tobacco, health costs of tobacco sales. With Costco, they were looking at greenhouse gas emission targets. So as shareholders, an individual or a fund can vote on shareholder resolutions. They can actually bring up shareholder resolutions, or they can just engage with the companies that they own. So they, especially when there's an issue, they're electing, the shareholders are electing members of the board of directors. They're influencing what's happening with the companies. If there's enough people voting, enough people making, pushing for a change, you can move companies. Now, I'll let you talk, Alex, but you know, this doesn't replace making government, you know, a carbon tax or making changes on a government multinational scale, but this is doing something, you know, keeping companies accountable.
Yeah, it's more like you said, you might not get as much return for your investment while, well, investing to something like this, like community investment. But in change of that, you get to actually do something good out of that little return that you are kind of sacrificing in order to, well, do put some effort in it. And definitely, I think that well, it depends a lot on what type of life you have right now and where you want to be in whatever amount of years. That's a comparison between the S&P 500 and.
Well, yeah. Now, I'd argue that for the community investment funds, for the risk you're taking, the return is not, probably it's well, it's a bit relative, but like the Calvert investment funds pay similar to a CD, but they're not as secure as a CD. Yeah. So you should be getting a little bit better return. you may be giving up a slight return of what you could get with the community investing. But as far as the SRI funds go, I mean, with engine number one, their expense ratio is pretty low, 0.05%. What I'd say is there's been studies of studies where they've looked at thousands of studies comparing SRI versus just standard indexes, and they found you're really not giving up much return at all. Now, this is a look at the S&P 500, the light blue, with an SRI fund that's screened for environmental social governance issues. It's an ETF. And you'll see that there's time periods where the SRI fund is outperforming the index, and this is just for large US companies. And there's periods where it's underperforming, but in the long run, there's studies saying you're not sacrificing return by considering environmental social governance. I think one of the big tracking differences between the S&P 500 of the US market and environmentally ESG screened fund is that the S&P 500 has about 10% in the fossil fuel industry. And when the fossil fuel industry is not performing well compared to the average return, it's best, or you're doing better by not having it in your portfolio. So in 2001, when tech stocks were going crazy, doing really well, and fossil fuel wasn't doing well, it was better not having fossil fuel. This last year in 2022, fossil fuel industry did great. You know, they had a lot of returns. Yeah. And so you saw some catch up, but I think that you could argue that using environmental social governance criteria doesn't hurt your performance. There is a larger expense. I think that's where you could argue that if we're engaging with companies, it costs something to engage with them. And that is something you're paying for. If you use an SRI, a sustainable, responsible, or a socially responsible investing ETF index that just does screening versus a mutual fund that's engaging, or an ETF that's engaging, there's more expense in the one that engages. And you'll see that in the higher expense ratio. And so even choosing within SRI, I think there's, there can be some differences in performance, or at least in expenses.
Yeah, and like if I were to be one of those people, to be honest, I do care a lot about environment. If I were to, like, I personally, I do invest, but if I were to tomorrow, I decide to change all of my portfolio to deep engagement, the SRI investment. Like, I want to invest only in funds that exclude oil, that avoids greenhouse emissions, that avoid everything related to climate change. How would that affect me on the short run and on the long run?
Yeah, I think excluding an industry will, of course, you'll do better when that industry is doing poor. Like fossil fuels is a great example. When fossil fuels are making super profits and they're like the only profitable sector in 2022, well, it's better if you have a bunch of fossil fuel companies in your portfolio. Now, just to make a point, there are funds like engine number one that they actually don't screen. They have fossil fuel in their portfolio, but they're trying to engage with those companies. They want to put environmentalists on the board of directors of ExxonMobil and of different fossil fuel companies. So they
actually doing investing on them in actually to make a difference on those sectors.
You got it. They're trying to invest in companies that are doing harm and try to move them in a good direction.
Good.
And I think the argument of how big of a change can they make? I mean, if all of us invested in funds like that are making an impact, well, we'd make more of an impact. Currently, of course, I mean, the government is making a bigger impact, positive or negative, than we are with each, little company engagement that we're doing. I think performance-wise, again, I think you can get a diversified portfolio, international, domestic, small, large, mid-sized companies, different types of green bonds. There are bonds that are SRI or bond funds that are SRI. There are community investing in opportunities. I think you could get a very diversified portfolio and you won't see a performance difference or performance loss over the long run. In 1 year where fossil fuels are doing great, yeah, you might underperform the index if you choose exclusion. Again,
Yeah.
there are funds that will invest in all of it, and they're just trying to engage.
Yeah. So it would be kind of better and doing more of an impact if I were to invest in those type of funds, trying to actually change something, change like a company that's doing harm or they are not so green, as we will say, instead of just excluding them out of my portfolio.
If you're trying to make an impact, the screening isn't helping you. You're not making an impact. You're just keeping them out of your portfolio, not making an impact. But for some people, you don't want them in your portfolio. That's fine, but that's a different argument. If you want to make an impact, the only thing we care about is engagement. So
That's a lot better.
yeah, I can share just a little. So, and some people want both. They don't want it in their portfolio and they don't want. So we use this tool called Your Stake, and they do screen funds, exchange trade funds or mutual funds based on the engagement. So you can have minimal engagement, you can have base engagement, you can have deep engagement, and then you can look at, what issues are most important to you, because not everyone's the same. You might care a lot about the environment, fossil fuel industries. Other people might care more about war or racial equity or animal rights. My kids, they could care less about humans. They say just helping out dogs. They really could care less about people having issues. So whatever. I mean, everyone has what they're most interested in,
Their own agenda.
their own priorities in organizations, especially if they're looking at certain things. Like I do some volunteering sometimes for immigration organization, the border issues. I'd feel bad if that border issues funds were in private prisons or detention centers or things related to that. Now, it's not going to help their portfolio performance to avoid those sectors, but you just might not want them in your portfolio.
Definitely.
In this tool, we can look at what your exposure is with migrant detention centers and just see, well, what funds are causing problems, and of those funds, why are they causing problems? What companies do they hold that are an issue, with that issue? But again, we have two different issues we're talking about: screening and then shareholder advocacy. In shareholder advocacy, this is where you make a change. And again, I gave you some examples for engine number one. This is Green Century. When you're investing in a fund, the fund is engaging with the companies on your behalf, or they're not engaging. Most index funds won't engage at all. So if I didn't care about engagement, yeah, I'd go for the cheapest, screened SRI fund available.
That sounds pretty good. And definitely I didn't have quite the image of that. To be honest, I'm the type of guy just to avoid the things that I don't like when it comes to finances. But definitely, now that you explain it like that, it's a lot better that you actually engage those problems in the correct way instead of just working your way around them.
Yeah, I mean, I think SRI is not one size fits all. I
Yeah,
think it's a conversation. And
yeah,
so we have clients that want nothing to do with fossil fuel. They hate it. They don't want it in their portfolio. And then we have clients who say, I'm okay with it in my portfolio as long as we're engaging with them. Um,
yeah.
and then
It
and we
depends a
have
lot on.
clients. Oh, go ahead. Sorry.
No, no, yeah, yeah. It depends a lot on how you want to engage those types of
I
issues.
think
Like,
there's a lot of flexibility. And we have clients that say, no, with my investment portfolio, I just want balanced diversification and everything. But with my banking, I'm going to be careful, or I want to do some community investment notes to try to help. There's
yeah,
lots of, it doesn't have to be an all or nothing. There's not one right way or right issues you have to be behind. Um, I think there's a tendency or a direction with the funds to support certain issues, but you can customize this for whatever degree of effort you want.
yeah. That's like a detailed talk to have for whatever client or potential client that you are currently having. Like, how much are they willing to do, or how much are they do they want to expend in something like this?
It is, and some clients come with an agenda, or they know, all right, I want to engage this way, or I don't want to engage this way, or I want screening, or I don't care. A lot of clients just show up and they've maybe have not even heard of SRI, or they barely know it's an option. And so we kind of have to guide the conversation. Here's some options. Screening doesn't make an impact, but you'll avoid some of these areas. And if enough of us are screening, maybe some of these companies will, screening eventually could make an impact. If we're all avoiding certain companies because they're scandalous or treating employees poorly or have a not diversified board of directors, then maybe screening could eventually make some change. But it's more shareholder advocacy is going to make the change, and community investing makes a
Yeah,
change.
no, no, definitely. I think that it's a good topic. Uh, a topic that we could definitely spend a lot of time just talking about is giving way more details about what is or what what it's not good to do on this. But well, I think that that's
Yeah, I mean,
one more
just
topic that we could explain on
yeah, just I
more
mean, just one
topics.
more point. I mean, I think it's taking a step. It's not replacing voting and political impacts and government
Yeah,
impacts. But it is taking a step. It's doing what you can. I mean, it's kind of like recycling or something. You personally recycling may not change the world, but you're doing what you can. You're doing a piece.
yeah,
Um,
yeah. And like you said, like if enough people engage on the correct way, that's when things can get different.
yeah, I think like Domini says something. The Domini funds. I remember reading somewhere that there's a story of someone whipping what are they, a starfish into the ocean, and there's
Yeah,
just tons of starfish, and she's whipping them into the ocean. And someone comes up and says, "What are you doing? You can't save all these starfish. That's impossible." And she says, "Well, at least I saved this one.
yeah,
You doing what you can. You do your part, and if enough of us are doing something, we can actually be a force to change companies or to make changes that are bigger."
yeah. No, definitely. Because but even so, like you said, it might be a metaphor, but in the end, like if you're doing something good, you can encourage others to do the same thing. And I mean, if you're doing good while doing something good for well for change, that could encourage a lot of people to start doing the same thing, and that's when things can definitely change the course of how things are doing right now.
And I think too, 10 years ago, 20 years ago, there were not as many investment options, and the expenses were high. It was hard to get diverse holdings. I mean, now, there is a lot of investment options. Expense ratios are way down. There's different strategies or ways to make a change with your investments. It's exciting, and you can evaluate what's going on. There's tools now to evaluate what your portfolio is doing.
Especially now that a lot of companies need to be held accountable for what they do. If like they need to be very transparent on what they actually do, or like there's a lot of people now that really are into this, that really care about the wastes that a lot of companies put on oh, water contamination, deforestation, all of that, and those are things that need to be considered when you want to do this type of investment as well.
You're right. I think there's more awareness too about climate change, about our environment. And so I think there's more energy around people wanting to, because it's big issues. I mean, it's you do what they can to help.
Yes. Well, I think that was it for today.
That's it. So again, we're AIO Financial. Our podcast, blog, videos around personal finance. You can find us at AIOfinancial.com. We are fee-only financial advisors. We also try to educate on personal finance. SRI is one of our specialties.
Well, if you have any comments, positive, negative, whatever, we are really glad to hear them or read them. So thanks a lot for your time and have a nice day.
Thanks. Bye.